Been a challenging time for investors trying to keep up with the flood of headlines and market moves. But what does this volatile environment mean for asset allocation? Joining us now to discuss, Christian Medeiros, VP Director and Portfolio Manager with TD Asset Management. Christian, always great to have you on the program.
Great to be back.
This obviously is a different environment than we had become accustomed to for a while, maybe even since the last time you were on the program. There was this outperformance of the U.S. equity markets, of the U.S. labor market, of the economy. We're in a bit of a different story now. What is the story now?
Yeah, so when we met early, the first show of the year, when we met, we talked about the consensus forecasts across Wall Street and Bay Street. And we ended the show by saying that the biggest risk to this forecast would be if U.S. exceptionalism were to end. And that's what we're seeing so far in the first few months of the year. And so what's going on is that America First policies have been taken to a strong degree. And America First has resulted in America Last, at least in terms of asset price performance. So the U.S. equity markets are some of the weakest performing regional markets in the world, whereas we've had the strongest outperformance, for example, in international equities versus the U.S. since 1988. So a huge divergence in equity market performance since the start of the year.
I think with the run that we had seen in U.S. equities and that outperformance before we entered this year, a lot of people are looking at what's happening now and trying to wonder, is this a temporary blip? Is this sort of Brad Simpson, the chief wealth strategist, he was on near the beginning of the year too. He said he wouldn't be surprised to see a 10% pullback in the markets from these levels. I think people are trying to figure out what happens with the American markets from here. Is that a pretty tough one at this stage?
Yeah, it's challenging. I think we have to take it back to the policies that we spoke about that the Trump administration was going to highlight. Tariffs, deregulation, immigration, and fiscal. And what we've seen so far is the worst of those policies. We've seen really high tariff rates and really chaotic tariff policy. We've seen pretty strong crackdown on immigration, which shrinks the labor force. We haven't seen much fiscal expansion. We've seen actually cuts in potential cuts in fiscal spending. And then lastly, deregulation has taken a back seat. So we're getting a negative policy mix. And the policy mix that we're seeing is one that's creating maximum uncertainty. There's maybe some benefits to the Trump administration in doing so. Maybe it makes trade negotiations easier. Maybe it helps them bring jobs back to the U.S., perhaps. Maybe it helps them reorganize the U.S. economy, as they're saying. Maybe it'll help them term out the debt. There's a lot of different policy priorities that they're trying to aim for with this bad policy mix. But if they take it too far, this uncertainty makes it really hard for businesses and individuals to plan. If you're an American corporation right now, I think you're having a hard time deciding what to invest in, how much capital expenditures will you have. If you're a consumer, maybe you might soon decide to pull back. We're not seeing that yet in the hard data, but the market's most concerned because of this overhang of uncertainty. So if this trade policy uncertainty persists, it's a good chance that this drawdown or this market unease could persist for some time. But if we do have a bit of a change from the administration, we could see a quick reversal.
It's pretty hard to tell the story without talking about Canada, because obviously when it comes to trade policy, there seems to be some irritants in Washington with us, their largest trading partner. What's the outlook for Canadian assets in an environment like this?
Yeah, I think everyone was taken by surprise by how aggressive Trump has been towards Canada, not just on trade, but also on sovereignty. That wasn't in most people's first guess. So what that means for Canada is that Canada is much more reliant on trade, and much more reliant on trade with the U.S. We're a small, open economy. So if we do have persistent trade uncertainty with the U.S., if we do have extra high tariff rates, we've heard 25, 50, maybe even 75 if you stack them all on certain sectors, that's going to be a huge headwind to the Canadian economy. So we're seeing okay Canadian data towards the end of last year, but now we're really quite worried about uncertainty. Central banks starting to get a little bit concerned about uncertainty. And so there's been a little bit of an overhang on Canadian assets. The Canadian dollar has been much weaker than global currencies, which have actually appreciated versus the U.S. dollar. Canadian equities have kind of treaded water, but much weaker than international equities. And Canadian fixed income has actually been kind of okay to holding in there. What we want to look for next in Canada is, do we have policy change here? Is there an election, and does that election bring major change? That could see a reversal in Canadian asset performance. So that's something to really watch for, is the Canadian election cycle, which is starting very soon.
Okay, let's take a look at Europe and Asia as well. When I think about this global trade disruption, there's really no region of the planet that is unscathed in all this. What are we thinking about Europe and Asia?
Yeah, so Europe's had an amazing outperformance to start the year. German equity markets are up nearly 18%. Europe as a whole is up in the strong double digits. A few reasons why. One is potential resolution of the Ukraine conflict is positive for them. We've seen them respond to an America First policy by doubling down on potentially investing in defense and investing in their own productivity, if you will. So huge amounts of fiscal spending were proposed by Germany. And then you've also seen pretty good growth performance from the peripheries. Spain, Greece, these countries that used to be seen negatively at the early part of last decade are now actually doing quite well and growing strongly. So it's been a pretty solid mix in Europe and resulted in good outperformance. The risk going forward is, do we have tariffs against Europe? Or are those the tariffs that are announced on April 2nd when Trump really comes out with his next foray into the tariff front? So I think that's the headwind to watch for there.
Europe, how about Asia? Because Asia's been outperforming as well.
Yeah, Asia's been mixed. It's been quite interesting. Yeah. So Chinese equities on the tech side, after DeepSeek and some other things, have really outperformed, some of the best performers of the year. But if you look at more traditional Chinese equity indices, haven't outperformed by that much. And then when you pivot, and then part of that is from a little bit more stimulus, but not quite enough stimulus to get investors excited, and more old economy stocks in China. When we look to Japan, equity market has been mixed, but the currency is vastly outperformed. And that's because the Japanese market is reflating. Higher wages, higher inflation. It's a different policy mix than we're used to in Japan. So that's kind of interesting, right? We're seeing a very big change in Europe and Japan from what we've seen, over the prior decade, where both had low growth, low fiscal, low levels of inflation. Both are starting to reflate, spend a little bit more, see higher wage growth. And that's kind of resulting in that big divergence we're seeing between US and international.
It's a great trip around the world. In the 6 or 7 minutes we've been talking, we put that all together in terms of asset allocation. What's the thinking here?
Yeah, I think the thinking is we've had a decade plus of US outperformance at the expense of everyone else. And if the US policy mix is changing in a way where they may spend less, where they'll be less involved in global trade, well, they're retrenched from the world, and the rest of the world is meant to fend for themselves, get their fiscal house in order, get their productivity in order, reinvest in their own domestic industries, we might see a very big divergence over the next decade. And if we look back over a long time, maybe 50, 60-year time span, there's decades in which the US outperforms, and there's many decades in which international outperforms. And so I think it's a really great time for investors to consider diversification in their portfolio. And that's why you shouldn't only hold one sector or one country. As the world changes, you need the diversification across regions.
I was thinking more in terms of sector mix in a portfolio. Now you're talking obviously country mix. So this adds sort of a different flavor to what some people might think of sometimes when they think about portfolio management and asset allocation.
Exactly. You might not get if you just buy the one US sector, you might not get the theme that's taking place in Europe, right? So the huge outperformance in, let's say, European defense stocks we've seen looks much better than the performance of US defense stocks, because it's really about a domestic story in Europe that's taking place. And so I think it does mean investors need to look more broadly, scour the world for opportunities, and have that global diversification.